The fourth condition is that the substantial operation of the relevant entities need to remain unchanged compared with the transaction is done. That is to say, the principal business activities of the concerned entities need to remain unchanged. And the fifth condition is that the relevant assets or equity should not be transferred out in the next 12 months. If the equity or assets transferred in was transferred out again in the next 12 months, the special CIT treatment would be clawed back. That's basically the 5 conditions. Apart from the 5 the conditions, there are also 3 conditions, especially for the cross-border deals. The 3 conditions mainly include the holding percentage of the relevant companies. Most of the conditions required 100% of the holding of the relevant companies, only especially for the overseas transactions. So this is the those are other conditions. Another question is, what is the benefit for a special CIT treatment? Basically, the special CIT treatment refers to the corporate income tax liabilities could be deferred to when the next transaction would occur. If the next transaction would not occur in our anticipation, so the corporate income tax could be deferred to forever. That's the benefits a special corporate income tax could bring to us. Okay.
I think what you have explained can be a bit complicated. There are basically 5 conditions to fulfill. In fact, a bit like our Singapore stamp duty, when you have a reorganization or restructuring, you can actually get the reduction of stamp duty to $10 or a very small amount. But again, there are a number of conditions to be fulfilled. It's quite a bit similar. So, Charles will be around after this seminar, before he flew off tomorrow to South Africa. So feel free to ask him. In Singapore, no fee, no charge. When he go back, you're going to render you a bill. Any question for Mr. Chen or Citibank? Actually, maybe I can kick off a question for Citibank. We do have many, let's say, foreign companies like PRC companies or companies from the States or Europe. They are using Singapore, as you say, as an offshore international trading hub. Yeah. So they'll buy and sell, but Singapore basically doing the invoicing and the collection. That's all. So does it mean that in future it is possible for the PRC companies who have, let's say, a company in Singapore, international trading company in Singapore under the Global Trader Program, to also open a renminbi accounts with Citibank Singapore?
Actually, that's a good question. I recently got involved in a particular Chinese company structure, doing global cash pooling for them on a daily basis to move money from 131 countries into Singapore. This particular Chinese company is actually under that Global Traders Program, so they do the re-invoicing here. In fact, it was very interesting. They used to have Hong Kong and Singapore, the main sales hubs. And now, increasingly, they're moving all the contracts from Hong Kong to Singapore. So to answer your question, yes. And in fact, what we have done in this particular proposal is that the Hong Kong PRC, the Hong Kong company, the Chinese company is the one that's manufacturing. But sales is generated from the Singapore or Hong Kong company. So let's use Singapore as an example. And then they will sell the goods and services to the client, for example, in Botswana. So Botswana will have a service company. So you have Botswana that owes money to the particular Chinese company, to the parent, right? So the trade outstanding has been like 2 years. So from the company's perspective, they want to they want to return all the outstandings and then pay back the trade receivables. So what we do is we move money into Singapore for them, and then from the Singapore entity, drain the pool in RMB and return the funds to the parent company. So you're actually reducing your trade payables from Botswana to the parent company. So that's a structure.
How does the renminbi come into picture?
The renminbi comes into picture because the outstanding is in RMB. So we allow, if there's collections in RMB, it's a RMB account offshore. Then you also have the collections in US dollars and other currency account. So to my previous example, they're tapping on the liquidity of the other currencies because there'll always be a mismatch. So they need to pay back in RMB, they drain using the liquidity from other currencies. Yeah.
Without physically moving the...
Without physically
that, I think that's important, so save a lot of bank charges. Actually, but they will earn elsewhere, you know, from your transactions. Yeah. You end up issue a lot of LC by Citibank Singapore. Yeah. Well, actually, it's true that Singapore getting popular because the Global Trader Program is very attractive to them in that their tax reduced to 10% and can be further reduced to 5% or even 0. Whereas in Hong Kong, in theory, some Hong Kong accountants will tell you that it's offshore trade, there's no Hong Kong tax, but actually it's a big question mark there. So for certainty, they would rather have it in Singapore. Secondly, also Singapore is an independent country, whereas Hong Kong is a SAR. Yeah. Okay, any question from the floor? Yeah.
Maybe I just wanted to add on what Shu Wei has mentioned. Previously, when we mentioned that with the internationalization of RMB, we can actually open up RMB accounts here. And she also mentioned that from the exporter point of view, a lot of companies are setting up the reinvoicing center here. So that we are talking about mostly offshore RMB market, exporter in Singapore, whether it's a Chinese company incorporated in Singapore or even a Singapore company located here trying to export to China and receiving RMB in China because they reinvoice in China. So wanted to find out, I thought that I would be anticipating some questions on, since RMB now is internationalized to a certain extent and freely convertible, so why are companies not invoicing, say, in US dollars, get receipts, collections in US dollars, convert all of them into RMB because RMB is going to be appreciating, and then keep it offshore? So I'm anticipating this question, but it seems that nobody is asking it, so I'll just answer these questions. Which I think probably maybe a lot of people would. Anybody interested in the answer? Yeah? Yeah, so, okay. So as an importer, for example, if you are going to be paying out and the Chinese entities are now saying that I want to invoice you in RMB, I want you to pay in RMB, right? And we said that yes, it's definitely not an issue, right? You can always open a RMB account with any banks who already has these RMB services in Singapore, and then you can do your conversion from US dollar into RMB and then pay it out subsequently to your suppliers in China. So, and to the certain extent, if the companies wanted to go into speculation, what they do is convert all their US dollars, excess US dollars now, into RMB, keep it till it appreciate, and then after that, convert back to US dollars, and you get the profit out of it, right? So, answer is no. There's no free lunch. You can't do that, right? And the reason being, this is actually opening up for trade settlement, right? So, which means that whenever you do a conversion, there are two restrictions. You do it with the anticipation that you are going to be paying out in RMB to the suppliers. This is one. Second, there's always an FX limit, right? PBOC is not going to promote RMB as to encourage people to speculate on RMB. They wanted to do it purely from an international point of view, making it an international currency for you to use RMB as a trade settlement. So for that, they control an FX limit through PBOC, which is a central bank in China. They control it within themselves. So they give FX limits to all the correspondent banks. So City China is one of them, Shanghai Pudong Development Bank, ICBC. they are all the correspondent